Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 426 on May the 8th, 2026. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on FuelCell Energy, SoundHound AI, Rigetti Computing, and Gamestop Corporation, and we discuss 4 new trades on Keel Infrastructure Corporation, Rackspace Technology, Sunrun Inc, and Redwire Corporation. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the markets were higher once again, with the S&P 500 index putting together an impressive 6 consecutive weeks of week-over-week gains. The Dow Jones Industrial Average finished the week 109 points higher, closing on Friday at 49,609 points. The S&P 500 index jumped 169 points, ending the week at 7,398 points. And now it's time for the topic of the week. The topic of the week is overcomplication. I love watching videos on option trading on YouTube. I do. So often the people explaining a trade find ways to overcomplicate it. Keep it simple, seriously. Don't trade anything you don't understand. If you hear of a trade that sounds complicated or you want to understand the risk, break it down to its simplest parts. I could tell you about 2-to-1 ratio trades where we sell the closer to the money strike and buy 2 farther out of the money strikes. The goal is to sell the one option to pay for 2 options. That's nothing more than a credit spread plus a free long option to the upside. We can discuss butterfly spreads. That is simply a credit spread and a debit spread back to back, depending on whether you bought it or sold it. Spreads are truly the building block of most of these strategies. So if you want to understand spreads, which we cover every week on this show, chances are you can understand some of the more complicated option trading strategies. Break the trades back down to the simplest part so that you understand them fully and can trade with confidence. So let's dive into the review of this week's or last week's trades. Kind of a mixed bag, but we'll get into it anyway. So we're going to start off with our covered call on FuelCell Energy, symbol F as in Foxtrot, C as in Charlie, E as in Echo, L as in Lima. At the time, the stock was trading for $13.27 per share. I looked at buying stock and selling the May 14 call at 90 cents. That could give us a return of 12.28% in 2 weeks. Well, shares of FuelCell Energy grew 43 cents, ending the week at $13.70 per share. The call option that we sold grew 15 cents, leaving us with a net profit of 28 cents if we were to close the trade down immediately. Now, with stock increasing and only 1 week until expiration, there's really no reason to exit this trade early yet. If the stock expires above $14 per share, all our original economics hold true. Now, if the stock expires for less than $14 per share, we get to keep the premium that we collected for selling the option, and then we immediately look to sell another option against the stock in the next month, which increases our overall return and our overall outlook on this trade. Another slightly more complicated possibility I don't discuss often on the show would be to buy the call option back and sell an in-the-money option. We would pay $1.05 for the 14 call, which is a loss on the option side of 15 cents. We would then sell the $13 call at $1.35. Take out our 15 cents, and that becomes $1.20. So now you are effectively selling stock at $14.20 per share. Since we originally bought the stock for $13.27 per share, we would be walking away from the trade with a profit of 93 cents per share if the price were to expire right where it is now. So I would personally prefer to just let the 14 call expire and keep the 90 cents of premium on Friday if the stock is below $14 per share. Then I would look to sell a June at the money call option on Monday, May 18th around $2. That's where they're trading right now. You want to let the one option expire before executing this so that you keep the full premium, and then you enter the next trade the next business day. So if we were able to do that, sell that option, that June option for around $2, then we will have collected a total of about $290 or so. That's premium that we get to collect and possibly keep versus a cash outlay of $1,327. That pushes the return up to 21.85% for the trade. So not having the option expire in the money just gives us more opportunities to increase our return on the trade overall, as long as we don't start losing money on our purchase price for the stock. So that's it for the covered call. Let's get into the cash secured put. So we looked at a cash secured put on SoundHound AI, symbol S as in Sierra, O as in Oscar, U as in uniform, N as in November. At the time, the stock was trading for $9.56 per share. I looked at selling the May 9.5 put at $1.04, hoping for a return of 10.95% in 2 weeks. Well, shares of SoundHound lost 68 cents, ending the week at $8.88 per share. The out-of-the-money put that we sold is now in the money, unfortunately. So the stock price is still above our break-even price, which is good, but at this point, we would need to definitely have a plan in case the stock continues to lower. At this point, you'll likely get assigned on the stock at $9.50 per share. And if that happens, prior to the actual stock price reaching the break-even point, you can close the trade out for a net profit still. Another option is that if you get assigned on the stock prior to expiration, is to go ahead and sell a call option at the original strike of the put, the 9.5 put, which is where you will have bought the stock, right? You will have paid $9.50 for the stock. So I would then manage the trade as if I was using a covered call, allowing it to expire in a week and then selling another call option against the shares of stock next month to increase my overall profit and overall return on the trade. So it's important to just track the prices and all of the strikes that you trade in order to make sure that you are staying in the profit and not doing something that just simply locks in a loss. Always do the math prior to making the move. You guys have heard me pound that table, and I will beat it again. Always do the math. All right, let's get into the credit spread for last week on Rigetti Computing, symbol R as in Romeo, G as in Golf, T as in Tango, I as in India. At the time, the stock was trading for $17.52 per share. I looked at selling the May 17 put spread at 17 cents. That could give me a maximum possible loss of 33 cents per spread. Now, shares of Rigetti grew $1.42, ending the week at $18.94 per share. The out-of-the-money put spread that we sold is even farther out of the money, which means this trade is working out as planned. Now, if stock remains above $17.50 per share over the next 5 days, this trade will expire out of the money, and we'll get to keep the money that we collected for selling the spread. So at this point, no adjustments are needed at all. Nice trade. Our final trade from last week was the debit spread on Gamestop Corporation, symbol G as in Golf, M as in Mike, E as in Echo. At the time, the stock was trading for $26.52 per share. I looked at buying the May 26 half call spread for 28 cents. That could give us a maximum gain of 22 cents, or that's a 78.57% return in 2 weeks. Well, shares of GameStop fell $2.25, ending the week at $24.27 per share. The in-the-money call spread that we bought is now way out of the money. It's definitely worth making some adjustments on this trade. But as I do the math on altering the spread and even selling out-of-the-money put spreads against it, it just doesn't look like it will offset the loss enough to make it worth altering the risk significantly. In fact, in some situations, increasing the risk. Sometimes I take a loss in the options and am thankful that I didn't lose way more money owning the stock. This, unfortunately, is one of those times. I'll keep doing the math to see if I can get a worthwhile adjustment prior to expiration, but if not, I'm definitely going to just chalk this up as a loss and keep on trucking. That's it for the review of last week's trades. May expiration is on Friday, May 15th, which is 1 week away. All trades on today's show will use the June 18th expiration for monthly options in June. We're going to start off with the covered call on Keel Infrastructure Corporation, symbol K as in Kilo, E as in Echo, E as in Echo, L as in Lima. The stock ended the week at $3.95 per share. I'm looking at buying the stock and selling the June 4 call at 60 cents, hoping for a return of 16.46% in 6 weeks. You enter this trade by buying stock for $3.95 and selling the June 4 call at 60 cents. This trade makes the most money if stock prices finish above $4 per share. The break-even price on this trade is $3.35 per share. In real terms, the stock purchase will require $395 and you'll collect $60 for selling the option. Next up, we have a cash secured put on Rackspace Technology, symbol R as in Romeo, X as in X-ray, T as in Tango. The stock ended the week at $5.49 per share. I'm looking at selling the June 5 put at 90 cents, hoping for a return of 18% in 6 weeks. Now you enter this trade by selling the June 5 put at 90 cents. This trade makes the most money if stock prices finish above $5 per share. The break-even price on this trade is $4.10 per share. In real terms, you'll collect $90 for selling the put option, and you'll have $500 locked up in case you need to purchase the stock. Our credit spread this week is going to be on Sunrun Inc., symbol R as in Romeo, U as in Uniform, N as in November. The stock ended the week at $14.62 per share. I'm looking at selling the June 14-13 put spread at 33 cents. That can give us a maximum possible loss of 67 cents per spread. Now you enter this trade by selling the June 14 put at $1.05 and concurrently buying the June 13 put for 72 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $14 per share. The break-even price is $13.67 per share. In real terms, you'll receive $33 per spread that you sell and have $67 at risk. And our final trade on this week's show is going to be a debit spread on Redwire Corporation, symbol R as in Romeo, D as in Delta, W as in Whiskey. The stock ended the week at $11.06 per share. I'm looking at buying the June 10-11 call spread for 55 cents. That could give us a maximum gain of 45 cents, or that would be an 81.82% return in 6 weeks. Now you enter this trade by buying the June 10 call for $2.05 and concurrently selling the June 11 call at $1.50. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $11 per share. The break-even price on the trade is $10.55 per share. In real terms, you'll pay $55 to enter the spread, and your maximum gain is $45 per spread. So that's it for this week's show. Thank you guys so much for listening. Hey, summertime is just about here. I hope you guys love summer the way I do. It's time to clean up the backyard, get the pool done, and it'll be ready to swim and have some parties very soon. So looking forward to more Memorial Day in the coming weeks as well. I love summer, and it's almost here. So you're going to hear a lot of happy shows in the coming weeks. So just anticipate it. Have a wonderful weekend. And as always, happy trading.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.